Hey, Robert.
Hey, Yaron.
So it's been quite a, what is it? It's 10, 11 days now since we last talked, and in the banking sector. So, why don't you just walk us through kind of what happened, particularly in those first few days with Silicon Valley Bank and then with Signature?
Well, yeah, it's been a crazy 2 weeks. 2 weeks ago, we had no inkling that the banking industry is about to plunge into a crisis.
Yep.
I mean, there's definitely been an impact of interest rates rising, particularly on some banks that have longer duration portfolios. And there have been times in the past where interest rate risings have, basically destroyed big sectors of the banking industry, what we used to call the thrift industry, the savings and loans, in the 1980s, although really the damage was done in the 70s.
70s, yeah.
But that was not where we were. I mean, it's been wild. So
well, walk us through how that happened in the SNL crisis. What is it that destroyed the banks?
Well, in the SNL crisis, we went from a regime of low inflation in the 50s to rising inflation in the 60s, and then spiking inflation in the 70s, hitting its peaks in the early 80s. And thrifts were a very narrow business model where they collected deposits and paid basically market rates, and then they made mortgage loans. They were the financiers for 30-year mortgages, and they held the loans on their books. There was no securitization going on at that time. And there was a saying that, it was great to run a thrift because you borrow at 3 with deposits, you'd lend at 6 with mortgages, and you'd be on the golf course by 3 o'clock because it just wasn't that complicated. And in part, it was not complicated because you were protected by this regulation called Regulation Q that prohibited banks from paying more than basically 3%. So you're guaranteed your profit margin, except of course you're not, because people have alternatives when it comes to where they're going to put their money. And back in the 60s and 70s, even the 80s, your banking relationship was pretty simple. It was a place to store money. It was an investment account more than the kind of bank transaction account that you have today. I mean, certainly people wrote checks and they paid bills, but it was all done in a very low-tech manner. You didn't have auto pay. You didn't have your mortgage automatically being paid. You didn't have your Venmo and your Zelle all set up through your bank account. So people were willing to take money out of their bank and put it into a money market fund, because at that point it was paying 9% or 12%. And so 3% was unacceptable. Deposits were flooding out of the banking system, so Regulation Q was removed. And then suddenly banks were paying 9% on their deposits and still losing deposits while they still had those 6% loans. That is a recipe for insolvency, both economic and what we call technical. Technical is when your assets, your loans are worth a lot less because interest rates have gone up. And your liabilities, your deposits, well, you still have to keep paying interest. You're economically insolvent because the interest you're paying is higher than what you're collecting on the loans. And how thrifts responded was to look for ways to get profitable. Yeah. And most of them, because they're real estate lenders, they moved to commercial real estate projects. The big benefit being they could make the rate relatively low, but then charge a couple points up front. So if you lent $100 million, you need to book $2 million of income up front on the loan points, and you could look profitable, but of course you were just kicking the problem down the road. And then of course it got worse because all the thrifts were making real estate loans, commercial real estate loans, and they didn't have any experience with that. So they're building shopping centers and office buildings that shouldn't have been built. And it was kind of a disaster. So it's something you would always want to avoid. And it is not where we were 2 weeks ago. We were not in a position where Silicon Valley Bank was paying, 6% on its deposits and only making 3% on its securities. They were still paying 0 on their deposits, and they were still making 2 or 3% on their securities. So they were technically insolvent, but they weren't economically insolvent. They were still actually quite profitable. And as time passes, they were going to get more and more profitable as they could pull those investments in securities and mortgage backs into higher yielding instruments.
what tipped it? What tipped them into insolvency? Because ultimately they were.
Well, that everything that I just described is predicated on whether you have deposits that are like the SNL's had, which were happy to leave because 3% was unacceptable when 9 or 12% was available elsewhere, or if you have deposits that are sticky. So traditionally, Silicon Valley Bank would take deposits from startup companies. They might get a $10 million check from a VC, and then that money goes in the checking account and they use it to do payroll and pay for rent and buy computers and whatever it is that they're doing. So you set up your auto pay to AWS through your bank account. You've got your payroll going through your bank account. You're a startup company where you're either going to become a billionaire or fail. And so you don't really care about whether you could now get 4% interest on some alternative. You're not interested in the difference between 0 and 4. You're interested in the difference between, having a
$0 and $1,000
company and $1 billion company.
Yeah.
So everyone 2 weeks ago thought that those deposits were very sticky because they always had been, and they were not interest rate sensitive versus the thrifts where the deposits had been sticky only because of regulation Q, and when that was eliminated, they were gone. And even before that, they were gone. So it turned out that the deposits were not price sensitive, but they also weren't sticky. So on Thursday, 2 weeks ago, so 2 weeks from ago tomorrow,
yep,
there was sort of a wide and sudden recognition that Silicon Valley Bank was technically insolvent. Now, they had been technically insolvent for months, but economically, everything seemed fine. So management wasn't worried, regulators weren't worried, depositors weren't worried. But of course, that all changes once somebody starts getting worried. Now, 2 weeks ago, the bank announced it was going to raise capital because it did have these accounting losses and they were going to fill in the hole. They made a strategic error in announcing that they were going to raise capital as opposed to announcing that they had raised capital. Yep. But even that was, in hindsight, it was clearly a mistake, but it was normal operating procedure. They announced the raise, they announced the lead investor. So it wasn't like they were saying, we're hoping we're going to raise capital. They said, we're going to raise this much capital. And this investor is taking, 25% of it, and we're going to fill in the rest over the next few days. And that's very normal. It's exactly how you would expect it to happen. It just turned out to fan the flames because it shone a spotlight on the fact that the bank was technically insolvent. And once the deposits started to leave, then the bank became actually insolvent, economically insolvent. And it happened very quickly because it takes very little time to move your money out of a bank these days. It used to be you'd have to go down to the bank and they would have to count you out money and you'd have to stand in line. And I'm pretty sure that wouldn't have happened. In fact, if all the CEOs of the tech companies and the VCs had to go down and stand in line at Silicon Valley Bank branch, because there aren't very many of them, it would have been a really long line, that they would have said, oh, screw it, we've got better things to do. And actually it would have been just fine.
Yep.
But that's not how it went. The deposits started to flee in large amounts, and Silicon Valley Bank was closed on Friday during the day, which is very unusual. And I'm not sure why that happened, as opposed to waiting till 5 o'clock, but it definitely fanned the flames of the panic. Now, let me take it back. It happened because the deposit outflows were occurring so rapidly.
Yep.
But within 48 hours, they had guaranteed all the deposits, the uninsured deposits. So it would have cost zero relative to the world we're currently in to have waited until after close on Friday and tried to find a buyer to assume the bank. Because what I mentioned before about having payroll and your mortgage auto paid and all the things that you do with your bank account these days, that is a big deal for Silicon Valley Bank customers. They had their entire businesses entangled with that bank account, and casting questions on whether that bank account would be functional come Monday morning, much less have the money there, whether the deposits would be covered. That made it, it definitely made it prudent, but you could argue that it would have been negligent to not take your money out of Silicon Valley Bank on Friday if you had that option. And the people who didn't and were looking at that decision on Saturday or Sunday, I'm sure they felt panicked. I mean, there was no guarantee that they were going to have their money, much less access to their money. And so choosing to close the bank on Friday morning, in hindsight, was a mistake. I don't think anyone understood it, but then it was all.
And then what about the delay of guaranteeing all the deposits? If they had closed it and guaranteed the deposits, everything, the dynamics would have been different.
Yes, if they had closed it on after 5 o'clock on Friday, and then before, it's usually when the markets close on Friday, or the end of business hours on the West Coast on Friday, before Asian markets open up on their Monday morning. So you don't have 48 hours, it's more like 36 hours, but you have a big chunk of time where basically nothing's happening in the world and nobody's paying a lot of attention. Everyone's doing whatever they're doing on the weekend. And that would have been the window where if you had closed and made the decision to cover all the deposits, you would have avoided any additional panic, because there was definitely panic happening on Thursday, but the real panic happened on Friday after the announcement.
Yep.
And then, of course, the policy decisions just got worse, because on Sunday, they closed Signature Bank in New York. And when I say they, it was New York regulators in conjunction with the Fed and the FDIC. I think in both cases, it's hard to know today who made the decisions, in terms of what happened and when it happened. But they were both, in hindsight, mistakes, because Signature was not technically insolvent. Signature had kind of an average securities mark. Almost any bank that owns securities, and that's most banks, not all banks, you either own securities or loans. And every bank who owns securities, the securities are worth less today than they were a year ago, because interest rates have gone up a lot. The same thing is true if you have loans, but loans are a little more, they're less heterogeneous. Securities are well understood. The mortgage backs trades elsewhere.
It's easy to mark them to market. You can understand the losses clearly.
And you can observe observe the actual prices of what people own, versus loans are all a little idiosyncratic. But you can do the same thing. If interest rates go up, the value of loans go down. But if you take all that into account, the rise in interest rates, Signature was not close to being insolvent. Silicon Valley Bank was definitely insolvent. First Republic was almost certainly insolvent because of long duration loans. It's harder with loans to know, but we can say with a pretty high degree of confidence that First Republic was, and probably is even more today.
Yeah.
But Signature was not. And what Signature is a massive pool of uninsured deposits. I think they're the only bank that was remotely close to Silicon Valley Bank. Silicon Valley Bank had the highest fraction of uninsured deposits in the country, and Signature was number 2 and fairly close. And so the decision to close Signature, it's hard to wrap your brain around right now, but I imagine, and hopefully someday we'll actually know this, because there are important lessons to be learned about the mistakes that were made over those 3 days.
Yep.
But with Signature, it was a signal that uninsured deposits were a problem. It was both that there had been a run on Signature deposits, which was true. They had apparently lost about 20 billion in deposits on Friday in sympathy to what was happening at Silicon Valley Bank. As Silicon Valley Bank was shut down, the bank failed, it was insolvent, and it was questionable whether uninsured depositors would get their money back. People started pulling uninsured deposits from other banks where Signature was an obvious candidate for contagion here. But Signature could cover those because those deposits, because they didn't have the same problem with being underwater so much on the securities, that if they sold all the securities at market prices, then their technical insolvency would become really blatant. So the decision to close Signature, which was a bank that hadn't failed at that point, cast doubt on every other bank with uninsured deposits. And while Signature and Silicon Valley Bank were outliers, every bank has uninsured deposits. And for most regional banks and national banks, the percentage is quite high. And these are not, $250,000 plus the interest CDs, where it's a small amount of uninsured. We're talking about $10 million accounts, $20 million accounts, $30 million accounts that
Business
are used
accounts.
to run businesses.
Yeah, these are businesses. Yeah.
And it's very hard for it's hugely value destructive, because it's hard for the business to recreate that relationship on the fly. But it's also on Friday or even on Sunday or even on Monday, when they had covered the uninsured deposits in those two banks.
Yeah.
But had said this is a special case and we're going to set up a fund, but had not explicitly covered uninsured deposits, and still hasn't. That leaving your money in a regional bank uninsured just to save the business relationship, which is very valuable to you, but is not as valuable to you as the actual cash that's in the bank, that was not a prudent decision. That was something that people were going to, if not take their money out, there was enough concern that they were going to take their money out, that stock prices plummeted, and everyone started writing about bank failures, which of course makes the problem even worse. And I want to make 2 points before I shut up here. One is that while all of this is related to psychology, like Silicon Valley Bank could have been just fine if no one had taken their deposits out. They would have earned back the hole in their balance sheet, and none of this would have happened. It was also reasonable to say we should take our money out, because if things go south, we don't know what's going to happen.
Mm-hmm.
And the same thing is true at Signature, but the same thing is true at hundreds of additional regional banks, including some quite large banks. And we leave out the national banks, where they've been revealed to be too big to fail. We know from the financial crisis that there's very little chance, justifiably or unjustifiably, that the government would allow JP Morgan or Wells or Citibank or Bank of America to go under. But right now, we don't know if the next year these banks could fail, and whether or not those deposits, the uninsured deposits, would just disappear.
So, it's psychology, but it made sense for people to pull out the money. But it certainly seems like regulators, as they usually do, kind of messed this up by, they intended to calm the markets down, closing the bad guys, and they're telling everybody we insured everything, and the result, as I think often happens, was exactly the reverse. And on Monday, bank stocks just got crushed because nobody knew who was next, why Signature was closed. Maybe other banks, if Signature could get closed, maybe other banks could get closed. What are the criteria? What are the regulators doing? And so instead of actually calming the markets, it seems like they created a worse situation.
It definitely seems that way. I mean, when you look at, and of course, last week, the way stock prices moved, it was just wild. So many bank stocks were down over 50% in the morning on Monday, and then they rebounded, and then on Tuesday rebounded massively, and then they plummeted again on Wednesday, and then rebounded massively on Thursday, and plummeted again on Friday. So there's clearly massive uncertainty in terms of what's really going on and what it means. And there were several regulatory choices that helped add to that uncertainty. One was the fact that Signature was closed, and nobody knew exactly why. So there are a couple ways that you could look at it. You could look at it as that the problem with uninsured deposits was much larger than people thought. It wasn't just Silicon Valley Bank, it was all banks. So that, of course, would have you flee regional bank stocks and flee regional bank depositors, would take that as a signal to flee. And the second thing was what the policy response would be, assuming that there was going to be a line drawn. Now, unfortunately, the line wasn't drawn after Silicon Valley Bank, because Silicon Valley Bank, was unique. It had massive uninsured deposits that were leaving, and it was technically insolvent. That's the kind of bank that is going to fail. It's unfortunate because you could have had the good equilibrium where Silicon Valley Bank continued to exist. That would be good for Silicon Valley. That would be obviously be good for depositors. It would be good for the shareholders. It would be good for everybody. And that's not how it went. That's how it goes sometimes. But drawing the line after anywhere else is much harder because, as you say, if Signature's going to be closed, well, then is everyone with over 70% uninsured deposits going to be closed? Or are the problems so much worse that more banks will need to be closed? And so it introduced a lot of uncertainty. And then we had our president go on TV and basically say all of the wrong things. Say things like,
we don't care about investors.
Or people who are responsible for this, they're going to suffer. Now, there's nothing wrong with saying that. I mean, I think both of us are anti-socializing the risk in business. Having situations where in business the upside belongs to the shareholders and the downside belongs to the taxpayers. Neither of us are strong advocates for deposit insurance. If we were starting from scratch, we would not design deposit insurance anything like it is today, and we wouldn't design it to be even bigger. But given where we were on the weekend, especially with the decision to close Signature, the only thing that you wanted to communicate was, we are going to stop this. We're going to do it in the same basic framework that we did for the financial crisis, where taxpayers, as in was the case with TARP, at least in the bank investments, ignore the auto company and the Solyndra type of investments, but in the bank investments, taxpayers make money. We're going to do this in a way where taxpayers are going to make money. We're going to do it in a way where we're not bailing out shareholders, and we're going to do it in a way where the banking system remains safe and sound. Depositors do not have to be concerned whether, one, their money is going to be there the next day, and two, whether their access to the money through their banking relationship is going to be there the next day. And you could have communicated the same things of the people who made the errors are going to lose money, without communicating, we have no idea how this is going to play out. We're just going to make sure that the people we don't like suffer. And so those three things, I think, set us up for the kind of volatility we saw last week, and we continue to see, because we still don't know what the eventual policy response is going to be. And the errors could go in all sorts of directions. It was a bad idea to be too strict, right after Silicon Valley Bank failed. I think protecting uninsured depositors, while arguably it's the wrong thing to do, it's also at that moment has a lot of social benefits. But if we remove the cap on deposit insurance and we don't do anything else, then we are setting ourselves up for, at some point in the future, having problems be even larger because we've socialized some of that risk.
Yep. And so let's talk about the long-term impact here, because I mean, this could go, of course, we don't know, because it could go a number of different routes, depending on the next policy response. If they do deposit insurance on all banks, that'll take us on one route. If they don't do anything, that'll take us on another route. But what are kind of the different scenarios that could pan out here?
I think at this point, we actually can see the short term. What's happening is there's been a lot of resources put at drawing the line after Signature. So you could argue that Signature Bank was the logical bank to close along with Silicon Valley Bank. But from a pure numbers standpoint, unless you put all your weight on uninsured deposits, First Republic is the natural bank to have the same kind of problems. Has lots of uninsured deposits, shares a depositor base. First Republic is big in Silicon Valley, and is technically insolvent. And so if you were going to let more banks fail, First Republic would have been the next domino to fall.
Yep.
And has been massive policy response to try and prevent that. So the first thing that the Fed and the FDIC set up was a specific for First Republic, a $70 billion line, so that would give them the liquidity they needed if deposits flowed out, which presumably they have, because then the larger banks, the national banks and the larger super regionals, put $30 billion in deposits into First Republic Bank. So replacing the uninsured deposits that were leaving. Basically, and this was the first response that I thought was actually clever, because you had uninsured deposits leaving First Republic and going to JP Morgan. And so JP Morgan says, look, you can do this all day long, but we're just going to take those and put them back into First Republic. Eventually people say, you know what, this seems like it's not worth the effort. Yeah. And so that circle, you know, it does transfer some value from First Republic to JP Morgan, because JP Morgan makes a spread on it. But that's not why JP Morgan is doing this. 30 billion is not a number that moves the needle for JP Morgan. They're doing it because they are impacted by the safety soundness of the entire banking industry. And they are, while arguably they could end up with all the money if you just allowed this to play itself out, there would be repercussions. And that's what I'm getting to, is that the other direction where this swings against us is you end up with a unlimited deposit insurance, which is, it appears we might already have made de facto, because the national banks have a big chunk of, you know, it's not 50% yet, but it's close, of the nation. Maybe actually today it is 50% of the nation's deposits, so effectively fully insured. And now we see with Silicon Valley Bank and Signature that if a bank fails, particularly a larger bank, you know, 100 billion in assets or something, that the deposits will be fully protected. It doesn't take much to say, well, if we're going to, in fact, cover 85% of the deposits implicitly, we might as well cover 100%. But there is a difference, because once you cover 100%, then there is a natural, we've seen this in the national banks already, there's a natural tendency to say, okay, well, now we need to manage these banks because we're on the hook. And it's a legitimate perspective. You know, if you or I had guaranteed all the losses somewhere, you know, in like our kids' lives, we would then be very invasive in trying to manage their lives so we don't end up on the hook for that money.
Yep.
That, I think, would be, in the long term, the worst outcome. But in the short term, the dominoes have stopped falling. There seems to be a large enough policy response to keep that going, even though there have been academic papers and people talking about how 20% of the industry is insolvent. That's only if all the deposits leave.
Yes.
and that's the thing about banking, is if all the deposits leave in any bank, the bank is gone.
Yep.
And even if it's JP Morgan, if you have all your deposits leave, you may be able to pay 98% of them off because you're a rock solid bank, but you will never be able to survive that kind of outflow. So banking depends on deposits being sticky, not all deposits, but a big chunk of deposits being sticky. And as a bank, you do that by making the banking relationship very valuable, which is exactly how it's gone. And today we question whether deposits are in fact sticky, and whether we will have that type of bank depositor relationship going forward.
So this is, in a sense, a massive acceleration of what we've talked about happening in the bank system, and that is the impact of technology, right? What makes them not sticky is my ability to go onto my phone and transfer, you know, $10 million, although banks don't make it that easy, but to transfer $10 million to another bank account very, very quickly, very, very easily, without having to walk to the bank and setting up accounts online and doing everything online. Fintech is changing the nature of banking as we speak. And this suggests that maybe it's happening even faster than we would have expected.
I think in some ways it definitely is. Like, as you point out, frictions in moving money around have gone down, but at the same time, in other areas they've gone up. They've gone up because there have been a lot of regulations put in place that make it hard to move large amounts of money.
Yep.
Particularly if you're trying to open a new bank account. These are typically fall under either know your customer or anti-money laundering, although they're basically the same. They're to try and have some insight and control over large money movements so that there's no use for nefarious purposes. And it's automatic, especially in the larger banks. If you try and wire $1 million to buy a piece of property, your bank is not going to let you have access to your money until you get on the phone with them and you answer the questions that they're required to ask you. This isn't the bank's idea. They are required to find out what you're doing with that money, where the money came from when it came into your account, and to get satisfactory answers, or you won't get your money. So it's gotten much easier to move money in theory, but in practice there are some frictions. And then of course, the entirety of your banking being done electronically means that there's no one point of change that allows you to switch from one bank to another. And if you go back 50 years, if you change banks, you had to get new checks. And until you got new checks, you were impacted. Yep. But once you got new checks, your entire banking life had been ported over. And today, if you think about all of the auto pay, or particularly for a business, if you have payroll, or if you have accounts that are in any way being used as security for other activities, it's a nightmare to move bank accounts. So yes, moving money, particularly small amounts, has become extremely easy, but moving your banking relationship and what that entails, I think, has actually become harder, and it will continue to become harder as we use more and more technology to give us easy access to our bank accounts, or the money in our bank accounts for our daily lives or our businesses' daily activities.
So just to kind of close, if from an Ingenuism perspective, if you were running the regulatory agencies right now, or even better, President of the United States, there's a thought for you. What could we do to use some of the Ingenuism principles to resolve some of these issues and move the banking industry onto a more positive footing?
Well, we've had some hopes that there was going to be experimentation and learning within the crypto space that would teach us a little more about, in the 21st century, what are the things we need to worry about, and what are some of the solutions to challenges within a payment system, or within a market, or even within a lending borrowing relationship. Unfortunately, that's been caught up in some, tangentially these problems, but they are linked. If Signature might have been closed because they banked crypto. There was a reason they were closed. We don't know what it was, but that's as good a guess as any. And so what we're left with is the traditional regulatory system, which is really the polar opposite of Ingenuism. It's designed by smart people with good intentions, but that inevitably are going to look at what's happened until now and how to respond to it. And so the regulators, I'm sure 2 weeks ago, were concerned about the kind of things that made the financial crisis such a problem versus what is making this particular banking crisis. So from an Ingenuism perspective, we would need to move towards a regulatory regime that wasn't one size fits all, that wasn't, I guess it's saying the same thing, designed to work at the entire industry level, but instead where you have opportunities for people to experiment and innovate. Now, the financial system can wreak havoc with the real economy. We've seen that. And so and then from an Ingenuism perspective, you don't want to experiment in ways that are potentially catastrophic. Yep. And that's why you start with launching your rockets that you expect to blow up with nobody in them. And you learn, but eventually you have to be willing to take some risk of loss, and you try and make it as small as possible. But if you're not willing to take any risk of loss, you never end up, the airplanes fly with nobody in them forever, and you never end up with commercial air travel. So here you would want to start relatively small. You wouldn't want to say, okay, we're going to wipe the regulatory slate clean for the entire banking industry, although that's tempting and is an interesting intellectual idea to think about. In practice, what we're going to do is we're going to set up where deposit insurance has different flavors. And I'm just throwing this out. Like, this is just one of a million. The idea of having the freedom to experiment is you could put ideas out like this out there. You could see whether they were interesting to people, and you could see what the market reaction would be. But right now, deposit insurance is cover 100% of losses up to $250,000. And beyond that, you're not protected. Well, most insurance is the reverse of that, where you might bear the cost of 10% of the losses up to $250,000. And then after that, everything is covered. Now, that isn't, most people aren't going to find that, individuals aren't going to find that very interesting, because what you want is your bank account to be just like the electricity. I guess in California and Puerto Rico, maybe that's not the right example to use, but something that always works. You just flip the switch and it's there. You open up your banking app and your money's just there and available. But you don't have to have the same deposit insurance regime for all customers. This type of regime might make perfect sense for a startup company, where you don't ignore your bank and its financial health and its reputation because someone else is going to cover the losses, but the losses are small enough that you can largely ignore it, and you don't have to panic the first moment that someone says, hey, wait a minute, Silicon Valley Bank looks like it's actually insolvent. So if we had that for commercial accounts that don't pay interest, just as an example, the time that we're at Silicon Valley Bank, where the total loss was, and let's make it 20% of the first $250,000, or make it 50% of the first $1 million, whatever the number is you want, the panic wouldn't have been there. Because if you had $12 million at Silicon Valley Bank, and the worst case scenario is that you actually only had $11.5 million at Silicon Valley Bank, you would have a very different attitude as a startup company than the possibility that your $11 million was only, I said 12
Was
million.
only to up to 250, and you'd lose all the rest. Yeah,
that you only had $250,000 and you're going to be shut down within 3 weeks because you're going to run out of money.
Yep.
And I just throw that out there because it makes way more sense than the deposit insurance scheme that we currently have for Silicon Valley Bank and its customers. But you're not allowed to experiment with that. But deposit insurance is only one of 1,000 different dimensions that we could be
Yep.
experimenting with. There could be cross guarantees between banks, which is what we see in the securities industry. Insurance companies, private insurance companies could be involved. The government is probably going to be involved, just because we know de facto that there's pressure and legitimate reason to consider stepping in disastrous times. But this isn't a disastrous time yet. And so the government stepping in to solve the problem today means you have people who haven't dealt with the financial crisis their entire careers trying to deal with this with no economic incentive to get it right, versus if we had cross guarantees or private insurance companies, or fill in the blank, if we had people who actually specialized in dealing with the fallout of Silicon Valley Bank, we might not have had a fallout at all, in which case the loss that has happened because of the errors that were made is just astounding. You've lost hundreds of billions of dollars in market value in regional banks. You've had people moving their deposits and losing banking relationships, which is hard to quantify, but is a huge value. And It's all so that we could save Silicon Valley Bank's uninsured depositors. We could have found a better way to do that. Or even worse, Signature, because Signature, most people probably haven't heard, but has been assumed. So they were closed, and then their assets were assumed by one of their peers in New York Community Bank, which is a standard method of doing this, because if you take a failed bank and you give it to one of their peers and you cut a sweetheart deal, you basically save two banks. One is closed, but their customers are now part of a new, healthier bank. And this was done dozens of times during the financial crisis when banks were failing. But the cost to the FDIC, so think about it. Signature Bank was closed 11 days ago. It precipitated a banking crisis that we haven't seen anything like since 2008. And arguably, this is more of a crisis because in 2008, we kind of knew what the problems were, and there was a crisis. Okay, it's a bigger crisis for regional banks, is what I should say. Yep. The problems were more concentrated in larger banks. And Signature is a regional bank. A week later, they sell the Signature Bank assets in a closed bank transaction. The FDIC, it's a $100 billion bank. The cost of the FDIC estimates is $2.5 billion. So after closing the bank, so gutting its franchise value, and then precipitating a banking crisis that has destroyed hundreds of billions of value. I mean, First Republic alone has lost more than $20 billion in equity value in that week. You lost $2.5 billion. So that's one way to interpret this is the FDIC did a great job because they minimized their losses. And in a different context, I would even be amenable, to that particular interpretation. But what really happened was we had a chance to do this on the cheap, and the people who were making the decisions have no skin in the game and no experience, and they totally blew it. And in a different regime, an Ingenuism type regime, you would have a lot of thought and experimentation going into whatever the framework was that was going to keep Silicon Valley Bank and First Republic and maybe even Signature and a handful of others, but keep them from spilling over to the rest of the industry.
Yeah, and I think this idea of skin in the game is crucial. In an Ingenuism world, the players would have skin in the game. That's how markets tend to allocate risk. They don't tend to create a situation where somebody has all the upside but no downside.
That's right. And without skin in the game, you make more mistakes, but even worse, you're much less inclined to learn from them. You have no reason to acknowledge your mistakes, which none of us like to do.
Yep. And
then learn from them.
All right. So I'm sure this is a topic we'll be returning to. I don't think this is over. And there's going to be some interesting developments, both short term and I think in the long run. And the markets are going to, and I think the industry is going to evolve as a consequence of what just happened. And it's going to be interesting to see how they evolve. So there'll be lots for us to discuss. So thanks, Robert.
You're welcome, Yaron. Take care.